Okay, I have two hands, but I have three things I have to manage, so bear with me a little. Um, First of all, let me thank TaxPrime for a very kind invitation to stand up here to talk with you about transfer pricing. It's a strange but true passion of mine to do transfer pricing because it's such an exciting topic. I like nothing better than reading OECD Transfer Pricing Guidelines, especially when I can't go to bed and sleep properly. I read it, it puts me to sleep immediately. I think it's important for me to explain my background. My name is Shee Boon. I was a Malaysian. My ancestry is Chinese. I lived for a long time in New Zealand, so I'm a New Zealand citizen. Currently, I am resident in the Netherlands. So for tax purposes, I'm taxed in the Netherlands. But for 3 months, I'm actually based in Singapore. So I'm a little bit international, just a little. Which means that I can't really tell you anything about Indonesia. That's why these people are here. And I can't really tell you about any country-specific things like Japan, you know. So I'm just talking to you a little bit about my international experience. Before joining the law firm, I worked in the tax authorities in New Zealand. I worked for a number of years in the OECD, where they developed all these guidelines. And I worked for quite a number of years at an institution called International Bureau of Fiscal Documentation. I think some of you might know it, some don't. It's an international research and training organization. So again, just to give you some background so that you don't misunderstand that I'm standing here representing the tax advisor or the clients, yeah, or the tax authorities, because I have all this background which is a little bit unusual. So some of the crazy things that I say, it's just because I'm crazy a little. Right? Based on some of the experiences I have, I'm going to maybe try to share with you some of the interesting things I've learned in my career in transfer pricing. Okay. Before somebody flashed the cards at me, I think somebody needs to keep time for me because I'm very excited about talking about transfer pricing. So sometimes I lose track of time. OECD Transfer Pricing Guidelines have changed because of BEPS. So 2017 is the BEPS changes. But you know, I think everybody should know that it is a living thing. So it changes every day, almost as we speak. Just a couple of days ago, OECD came out with something new that hasn't made it into the to the guideline yet. So it's something that you need to keep in mind. It changes all the time. But since the last change, we have been introduced to some of the new things. For example, the idea of using transfer pricing not just as a pricing tool, but as somehow like an anti-avoidance rule. That's new, because OECD guidelines introduced ideas of, you know, allocation of risks, and you can reallocate risks if the conduct is not consistent with the contractual allocation of risks. That's a new idea in the post-BEPS guideline. The guideline also has been updated to say, okay, in some circumstances, we can use arm's length principle to not recognize a transaction that taxpayers have entered into. That's quite new. The threshold has been always there, but it's been highlighted more and more in the OECD guidelines. So you can see from here that actually tax authorities are using the guideline these days not only as a pricing tool. So if you are really like what Amin was saying, talking about whether the margin should be cost plus 2.5 or it should be cost plus 3.5, you know, I think you are in a good discussion there. So you should just shut up and agree to everything that tax authorities tell you, because it can get much worse. because the OECD guidelines did say actually you can use the OECD guidelines now to act almost like an anti-avoidance rule to say actually this transaction completely is not recognized. Yeah. So if you're in that sort of space of discussion, then OECD guidelines has a different meaning. Okay? The second thing that BEPS introduced is this idea of alignment between profits and substance, essentially, right? And because of this idea, now we are not just talking about routine versus non-routine returns for all the entities. Yeah. So if you read the OECD guidelines very carefully, these days there are at least 5 types of remuneration models that you can use. Yeah? We're not talking about really just a discussion around the margin, but we're talking about 5 fundamental different types of remuneration models. Okay? So if you're an entity, for example, that has an intangible, then you're talking about a very specific type of remuneration, because there you would be entitled to share a profit that the group has made. Yeah? If you don't have an intangible, you might have something very specific that is valuable, which needs to be adjusted. Right? So you're talking about an adjusted cost or adjusted profits kind of remuneration. So it's not really just talking about returns. I need to go back to that slide. I'm not done with it. The second type, right? And then you have really the third type, which is a routine return. So if you're doing something very simple, you get a cost plus, or you get TNMM, or you're getting a resale minus, right? So that's a third category. We used to put all sorts of entities into that category and argue about the margin. Yeah. But that's really a very simple argument. With the post-BEPS guidelines, you can have, instead of cost plus, you can have adjusted costs, and then you can argue about plus, right? So you can argue about the adjustment first, and then the total adjusted cost, and then you argue about the plus. Yeah? It's really getting more complicated because of the post-BEPS guideline. And then on top of that, there are 2 more categories. So if you are an entity that you don't do anything, you just provide funding, then you have to have a return based on interest rate. And there you have another adjustment that is possible is if you do some analysis and you take on some risks with this funding, then you do essentially a interest but adjusted, a risk-adjusted return, yeah? Risk-adjusted interest rate return. So if I count the number of remuneration models in this new guideline, then suddenly the potential for having discussions with tax authorities, with your advisors, with everybody, just kind of exploded. Right? We used to have this argument within one category, yeah, TNMM. Right? So you might make a choice between its cost plus or is it resale minus, and then you might have an argument about what's the margin. That's about it. But with these guidelines, you can have discussions in 5 different types of remuneration categories, and in each category you have to talk about the margin. Yeah? The third thing that post-BEPS introduced is transfer pricing documentation. So in Indonesia, I learned that you're familiar with that. We're not only required to prepare 1 set of documents, we have to prepare 3. Right? So you have your local file, you have your master file, and you have country-by-country report. And if you comply with the BEPS and you do everything, then that's what you expected to do. So we're sort of learning to do that in a way, because this is also very new. And then finally, the idea of using the profit split methodology. So OECD actually, after the 2017 update, come up with another update. So you won't actually find this in the 2017 update because it's a 2018 update to actually update when we can use profit split methodology. So as I listened to Pak Amin this morning, most of the methodology you use here in Indonesia seems to be TNMM. Right? So TNMM is what I would call a one-sided transfer pricing method. So what you do there is really, you have a cross-border transaction, you pick the simplest entity and you benchmark that entity, and you do TNMM. No matter what you do, you can produce 300 pages of TP documentation, you are still really looking at one side of the entity. You're saying, okay, what does this entity do? What is its comparable entity do? How much margin that comparable entity earns? But in this whole process, you never have to tell the story about what happened to the other party, right? What's the other party doing? Right? So for all you know, the other party is doing nothing. Or the other party could be doing everything, right? So you never really have to tell that story in TNMM. But what profit split methodology requires you to do is to look at both sides. It's to say, okay, I bring this to the party, the other party brings something else, right? So what is the relative value of this contribution? Then we use that as a basis to split the profit. So what OECD now says is that you don't really have to go to profit split methodology. You only go to profit split methodology in fairly limited circumstances. Yeah? When both parties bring valuable intangibles, when the risks are very integrated. So if one party does something and it will seriously, affect the risks of the other party, or vice versa, then you can use the profit split methodology. And these are pretty much the circumstances where OECD would say you need to go to this profit split methodology. So in a way, it's not encouraging everybody to go and use the profit split methodology. Yeah? So that's, I think, more or less caught up to the OECD guidelines. I think to me, partly because I worked with the OECD before, and I'm a little bit skeptical about the OECD guidelines sometimes, right? So fundamentally, what you think, I think that's behind a lot of the controversies and difficulties we face with OECD guidelines is that OECD guideline fundamentally has a bias towards one-sided methodology. Yeah? And in essence, what it is trying to do is to say, okay, you just analyze this, and you forget about the other side. And as long as you find a benchmark for one side and be able to justify it, that's fine, right? But more and more, I find that tax authorities are getting dissatisfied with this one-sided methodology. And you will find that most of the disputes you face and the questions that you get asked by tax authorities stem from this limitation in the OECD methodology. Right? You use TNMM 98% of the time. And in all those times, the tax authorities will be wondering, it's fine, that's what you're telling me about Indonesian entity, but what about your Singaporean entity, your Japanese entity, what are they doing, right? Because you never tell me anything in your 200-page transfer pricing documentation, right? And I really want to know. And I think that's a lot of the time the discussion you have with the OECD methodology. The other limitation in the OECD methodology, I think, that is still really being subject to debate is the inherent bias in the idea of, it's essentially a residence-based model, right? So the emphasis it puts on is that it will reward the assumption of risks, yeah? And it will reward the assumption of capital risk in particular, okay? But it will not reward things like market size, user participation. Those are the things that we are still discuss because of the digitalization of economy, and we're talking more and more about, okay, do we need to find a way in transfer pricing methodology to reward market size or market intangibles or user participation? These are concepts that OECD technique don't actually reward, right? We see a little bit of challenge as a result of intangible project that when you provide capital, it doesn't mean that you can take everything, right? Because because of the update in post-BEPS, when you provide capital, you get interest return. In some cases, you get risk-adjusted interest rate return. That's already a very significant compromise in the OECD guidelines. Yeah? Because normally it rewards capital. And a lot of the businesses, they are really struggling with that idea because like, if I put in all the money, I take all the risks, why do I only get interest rate return, right? And that's often a struggle for entrepreneurs and people who own businesses, and some of whom are probably here, to try to explain to the tax authorities actually putting in money is not everything. It's a struggle. Yeah? And similarly, now we are having to challenge the idea of market size because you have, I think one of your famous app is Gojek, and we all know Airbnb, we know Uber. I mean, this kind of technology, you can't really think about the way they earn profits just looking at functions, assets, and risks. You have to also consider market size, user participation. Those are factors that OECD don't really have at the moment. So the challenges we face with trying to implement transfer pricing in this digitalizing world is going to be even more challenging. Yeah. So that serves as the backdrop. I think in practice, in most multinational corporations, you are talking about a range of transactions inside an organization. This is a typical cross section of all the activities that you might do in a multinational enterprises. And there is a range of intra-group transactions that are subject to these transfer pricing rules in OECD guidelines, right? Some of that you might have to deal with, others you don't because you are only part of a small organization, a small part of a big organization. But overall picture is that you have this range of activities that generate the profits of a company, and in essence, how do you allocate that? And you can usually break them down into all the specific things. In manufacturing, you might be dealing with things like procurement. You might be really looking at how you convert raw material into something else. In distribution, you might be looking at sort of marketing services. You might be talking about purchasing and distributing goods, having a network of customers. So, and it goes on. Yeah. And then in the more recent kind of discussion, we have this digitalization process. If you do digitalization process like using data, how do you actually come up with a remuneration model for that sort of business process? And these are the challenges that I think we still are waiting to resolve in digitalization. So we're looking forward to more disputes about this topic. Yeah. Okay. I want to sort of maybe just pick out 3 or 4 areas just to highlight what the issues are in each of these. So if you look at the range of transactions that you might come across, the big group of transactions that are under dispute often is around the supply chain. Yeah? So you might be manufacturing or distributing, or you do both. You take raw materials, manufacture, and then you send out to distributor to distribute to market. Throughout this supply chain, there are a number of transfer pricing issues. How do you deal with those issues, right? To me, the most difficult, the core of the problem is really in terms of each entity's value add to this function, right? And what OECD guidelines requires us to do these days is to say, okay, let's identify the entities that have the most value add. That's really, and then we have to reward each of these entities based on their value add. in this supply chain. Okay? So you have to look at it from that kind of point of view to come up with a transfer pricing policy that makes sense, to align that value add with the profitability. So you can't really end up with the situations where you reward an entity in this supply chain that actually doesn't do anything, right? If the transfer pricing policy end up with that result, then there's something seriously wrong. And therefore you should expect that, there will be discussions with tax authorities if that's the outcome of your transfer pricing policy. Yeah? I think one of the most difficult challenge that we face is actually even the first part, which is really to try and convince companies that in a lot of these situations, you need a legal agreement, right? You'd be surprised that there's how many multinationals that do these kind of intra-group transactions, but they don't really put in place a legal agreement to do it. And this is particularly true with intangibles. In third-party situations, when you have something valuable, you don't just allow someone else to use it without putting in place an agreement, right? But you find that in intra-group situations all the time, because, well, we're all part of the same family. It's like my father can let me use his car without having an agreement, but in third-party situations, I have to enter into a leasing contract in order to be able to use someone else's car, right? So I think a lot of the difficulties is really very basic to actually detach yourself and then say, arm's length principle means, well, we have to behave like we don't know each other, right? And if we don't know each other, what would we do, Intangibles, intangibles has changed, really, and yet in some areas it hasn't. So intangibles is probably one of the most controversial change introduced by BEPS. Yeah. It's controversial to the extent that it creates a new word, a new English word that nobody else knows before. I don't know how many of you use damper in your day-to-day conversation, but damper, 2 years ago, did not exist. This is not even a word. Yeah? But some of my colleagues are using this as if this is common, everyday English language. Yeah? Damper. If I say damper, and you know what I mean, I know you are in transfer pricing. Right? Nobody else would understand what damper means except transfer pricing people, right? But if you are Chinese, then I have to modify it especially, and I will have to say it's damn pep. Because in Chinese, they add another P at the back of it to signify the importance of promotion activities, right? So you all know damper. Do you even know what damper means? Have you memorized what damper means? Development, enhancements, maintenance, protection, and exploitation. See, I can remember. It took me a while, though, I have to say. For the first 6 months, every time I say damper, I have to check with my colleagues, have I said it right? Because D stands for what again? I have to check. But what this change means, however, is that really a lot of the BEPS change has focused on the income side, right? So you have a payer of intangibles and you have a payee of intangibles, right? The change in damper is introducing the idea that income has to follow the entities that perform damper function. So the change primarily happens on the income side. So it creates the idea that if you are an entity that carries out damper, or if you are a country that hosts those entities that carry out damper, then you are entitled to a share of the intangible related profits. Yeah? So you're talking about primarily who has the right to earn that income related to intangibles. Yeah? But there is the other side, which hasn't really changed because of BEPS, which is it right to pay this amount? Right? So it's not really very easy to to make that that link. But I'm going to try, because I think on the income side, there are a lot of developed countries trying to make sure that they earn a share of revenue from intangibles. So BEPS is primarily a result of that kind of discussion. Yeah. For services, nothing has changed in post-BEPS guidelines. Essentially, other than the low value add service, it hasn't really changed. For services, we're really still talking about two things. One is that has there actually been any service being provided? So you'll be surprised how many multinationals, they just charge service fees without any justification. And that's something that will come under scrutiny. And then once you get past that, then there's an amount. So is this a service that can be charged or not charged is the first question. Once it is chargeable, then what is the markup? To be fair, once you get past the first hurdle, the markup discussion is relatively easy. Right? It's either cost plus 3 or cost plus 5 or cost plus 10. It's, you know, just agree to it and move on. Right? Intra-group finance is something that is evolving. OECD put out a discussion paper on this not so long ago. It's not really, in my mind, up to standards. I'm not the only one who says that, I think. It's something that will still evolve. But in there, something to watch out for is that when you have intra-group financial transaction, yeah, that it needs to meet arm's length principle. There you have to justify, is it a loan? And how much interest do you have to charge on that loan? Both aspects have to be challenged. And then there are other types of financial transactions like guarantees, cash pooling, then becomes more sophisticated and much more challenging to do, right? Okay. And then digital activities. This is a discussion paper that just came out 2 days ago from the OECD. I think there are a number of elements in the digital activities solution. Its transfer pricing aspect is one element of it, really. It is nothing more than that. But it will challenge the way we think about how we reward entities. And here is the opportunity where tax authorities might bring in market size or market intangibles or user participation as a justification for earning that residual profits. So countries that have a big market like China and Indonesia, you might, once these guidelines get finalized and comes into law, might lead to discussions around how much profits you can earn because the entity has access to the market. Yeah, and that will be very different from current rules. I am really limited by time, so I'm going to just really try to summarize this with just this one slide. Okay, I think a lot of the message that we take through is very simple, but I think this is what I struggle when I explain to clients or with my colleagues is when you go in front of a multinational companies, like some of you present here, the thing is that arm's length principle is here, right? Everybody uses it. All the countries use it. So the last time I counted, 150 countries use it. Even countries in Africa have adopted arm's length principle, right? And that's where things are a little bit slower to take up. But they have moved to that space already. So what that means is that actually it's not enough anymore to behave in an arm's length way. Right? You might have internal pricing policies that reflects arm's length. So when I talk to, say, clients, they tell me, oh, we set the price based on market, based on competitors, based on sometimes mutual negotiation. We behave like we are independent anyway, so that's how we set the price. Okay, that's good, because your price is fundamentally consistent with the arm's length principle, but the problem is we still need to prove it. Right? We need to document it and prove it. So just you saying that it's consistent with arm's length is not enough anymore. You have to prove it because documentation is an obligation under the new guidelines, right? And the way we need to document it is also become more transparent because they get shared and they get exchanged with tax authorities. At the end, once it becomes transparent, it leads to all sorts of questions and controversies, right, during audit. Because tax authorities are going to ask you questions. Sometimes this question cannot be answered by your documentation. Why? Because OECD methodology is one-sided, right? So a lot of the documentation that you prepare, I know you pay Big Four a lot of money to prepare it, but it is still fundamentally one-sided. So when you come into an audit or a controversy, you have to be prepared to explain the other side, right? You can't just say, oh, the other side is Singapore and we don't have any information. This used to be the old ways you deal with it, right? Because you say, okay, the tax authorities come to you and they want you to give them information about the parent entity or the principal entity in another country, and you usually say, oh, it's outside of my jurisdiction. My parent has it, I don't. Right? But in this transparent world, this kind of strategy might not be the best, right? Because if you do that, the tax authorities have another way to find it because they have exchange of information, they have all those mechanisms now. So it requires a rethink around how we do these things. And then in a lot of the cases, you want to try to lock it in with an advanced pricing agreement and to use that in a strategic way. I think that's really pretty much what I have to say. Thank you for your patience. I have quite a few more slides, but you know, the trouble is I like to talk too much.
Okay, thank you very much.